Webinar today, I want to introduce our Chief Investment Officer, Tyler Vernon.
Hi, everybody. Thanks for being on the call here today. I am here in Princeton. I'm the Chief Investment Officer of Biltmore Capital. And I just want to start with a quick disclaimer, and then we'll jump right into it. What we're going to talk about today is really for informational and educational purposes only. It's not an offer to purchase securities or invest with our company. MLPs certainly aren't right for everybody, and I think that'll make the attorneys happy. So, and I also wanted to thank our partners at Cushing who have helped supply us with some of the valuable data that we're going to talk a little bit about today. As you may know, this is a webinar series. Biltmore specializes in putting together alternative strategies to the stock market in investment portfolios. And our next webinar will be in April. We'll be talking about REITs and real estate investment trusts, et cetera. We'll probably send out an invitation over the next few weeks for that. And so with that, we'll move on here with the webinar. We plan on being probably about 15 minutes. We want to make these, fairly time efficient, so everybody who's out there that's working and not retired can get back to their day job. What I want to do today is just talk about Biltmore and our focus on alternative investments. We'll get into, the different MLPs and sort of how they work, a little bit of the history behind them and performance, and then we'll probably get into some Q&A. And for the people who are logged in here, there's a couple ways at the end that you can ask a question. You can either type it in, or should be a little button to raise your hand, and what we'll do is just unmute you, and you can ask the question over the webinar. So hopefully all this technology will come together. First thing, we just want to spend a couple minutes to talk about the stock market and the history of the stock market, because I think when you go to a lot of the large Wall Street firms, you generally sit down in front of somebody and you'll get some kind of mix of stock and bonds and be told to hold that for the long haul and that everything will be okay. And I think if you go back and study the history of the market, you might come to a different conclusion, and that's why we start with this page. Back in the early part of the century, about 1905, if you had held the market, you would have had about 18 years of sideways performance, and you actually would have been down about 4% over those 18 years. If you were this lucky guy that invested, sorry about that, at the peak of the market in 1929, it took about 25 years for you to get your money back. And more recently, the late 60s to the early 80s, market sideways for about 17 years. And of course, we all know the last 10 or 11 years, we've had two drops of about 50%. And if you stayed in the market and didn't sell and buy at the wrong time, you are probably about flat from where you were back about 10, 11 years ago. So we ask our clients the question, is it right to have this over-allocation to equities all the time, which is really, I think, a common approach to financial planning, especially at a lot of the larger firms and a lot of the smaller firms as well. And while I think it is right to be overweighted at certain periods of time, the question begs, is now the time to really be sitting on lots of stock for the long haul? And we would talk a little bit about our philosophies. And we've done a lot of studying. We've looked at traditional portfolios, and that's this pie on the left. Most people, when they walk into, again, a financial planning organization, depending on the risk tolerance and investment needs, they generally get some kind of mix of stock and bonds. And that's this pie chart on the left, and maybe to diversify a little bit, there'll be some international stocks and maybe a little bit of cash. Well, institutions, and what I mean by that, these are the Harvards of the world, the Yales, the large endowments. It's really interesting. They've actually done much better than individuals over time. I believe Harvard, as of the end of last year, had over 10% annualized return over this last decade, which is pretty, phenomenal given the conditions that we just looked at. And one of the things that we see as being huge differentiators are the large amount in alternative strategies and alternative assets. And that's really what this, this series of webinars is here to talk about, is really what are these alternatives, trying to demystify these alternatives and make us all understand them a little bit more. So traditional investments on the left, we've talked about domestic stocks, international stocks, big companies, small companies, et cetera, different kinds of bonds. And we classify alternatives on the right here, alternative assets such as REITs, real estate, energy through master limited partnerships, which we're going to talk a little bit about here in just a second, commodities, as well as alternative strategies, managers that can buy into the market as well as short the market, long-short equity that's called global macro, and managed futures. So, while there's a lot going on in this alternative space, again, each one of these webinars will be designed just to dig into each one in a little bit more detail. This is an interesting chart. Again, it kind of looks like the the periodic table in chemistry class, as you might have learned about it in 7th or 8th grade. But the important thing is, I think if we look here down to the light green, starting on the left, you see large cap stocks, basically the S&P 500. It was down 9 in 2000, down 12 in 2001, and then down another 22 in year 2002. So everything to the north of this black line represents positive performance. Everything to the south of it represents negative performance. And most people that were in this land of stock market only investing experienced that drop, a significant drop over that period of time of almost 50%. But if we look at all these other sort of alternatives, in the bright green being what we're talking about today, master limited partnerships, they were down a little bit in 2002 when the stock market really got hit. They were down in 2008. But there's some real attributes that we'll talk about. But you can see all these other alternative strategies like managed futures. They were up every year when the market was moving down in 2000, 2001, and 2002. Managed futures, again, up in 2008. So at Biltmore, we just believe in having lots of these different alternative strategies to help zig when the portfolio might zag, if you will. So let's get into master limited partnerships and just talk a little bit about the basics of them, and then we'll talk about some of the more specifics about that asset class. MLPs are short for master limited partnerships. They trade publicly as equities. They own and operate infrastructure, energy infrastructure throughout North America. So these are pipelines, gathering systems, storage facilities, et cetera, for natural gas and oil. And there's really three key attributes to MLPs. They typically have provided a high income, inflation protection, and a low correlation to other markets, helping to provide real diversification. I think that's one of the issues that you see in in a 2000 to 2002, for example, and even in 2008, although MLPs didn't get out from some of the trouble in 2008. But more and more, these different asset classes are becoming more correlated, meaning that if something falls, everything falls. And so again, what we're trying to do is find assets that could zig when other ones zag. And that's one of the reasons why we like MLPs, and we'll talk about correlations in just a minute. These businesses typically are cash cows. They pay out investors a good chunk of their equity. They traditionally pay 5 to 8% income on average. And with the Fed saying that rates are going to stay low through 2014, income is pretty scarce, and MLPs are one of the asset classes that have income. It's a pretty attractive business model. I think the best way to think about MLPs are being a toll road for energy, and it gets the gas and oil to the end user and essentially charges this toll along the way, which they end up giving to you as far as one of the equity owners of the company. They typically own hard assets that can inflate over time, and they can bake inflation into their contract pricing. And we can see here that really, in all levels of, of the kind of creation of energy, the transportation of it, and delivering it to the end user, MLPs are in that sort of environment. So from drilling to the production to the pipelines and the transportation and storage to bringing it downstream to the end users, residential, commercial, et cetera. If we take a look at the performance, it's been pretty compelling. And this is one fund that's out there that we look at and we use sometimes. On the top is the performance, and this we'll track the index pretty good. So you can see the performance over time. One sizable down year in 2008. You can see the average annual yield. So again, 7%, 7%, 6%, almost 6%. The yield jumped up in 2008. 2009, it was really compelling, and it's still pretty compelling at this point in 2012. The S&P 500 returns, we've put that below just to give a frame of reference for what the stock market has done over that period of time. And we can see almost every year, if not every year, it looks like every year we've had outperformance by the MLP index. So, and again, with a large majority of that being in income, it's been pretty interesting. I think one of the other really interesting things that we like about the index is its lower correlation. So for those of you who understand correlation, again, what we're trying to find, as I talked about before, are just things that can perform independent of the direction of the stock market. And generally a lower correlation and even a negative correlation will express that type of return profile and what again, having an asset that can, in fact, perform independent of the stock market. So the index has shy of a 0.5 correlation to the S&P 500, about a 0.35 correlation to REITs, and over here, looking at the 10-year Treasury, there's actually a negative correlation to the 10-year Treasury. So again, we're looking at a time period from 2002 to 2007 or 11, which represents high interest rates, low interest rates, different presidential cycles, et cetera. So again, correlation we think is almost as important as the return history, if not more important, as we continue to look forward. One of the benefits of MLPs has been that they've typically provided a great hedge against inflation. One of the reasons for this is that they've owned real assets, the value which has tended to inflate over time. They also have inflation plus pricing within their services. So, as we get inflation continue to increase, they essentially pass that on to their customers and are able to increase their distributions to you, as far as their equity owners. And we can see this is measured on the bottom. I think this is really an interesting chart. What it does is it shows, again, the kind of the dotted line that just goes sideways is a measure of inflation, CPI, and the annual distribution growth of MLPs are sort of the bar charts. And you can see, again, it's been pretty impressive since 2000. The kind of worst growth of the income has been about 3%. We've had as high as 12%. And I think most industry groups that you talk about will say that they expect that the distribution growth should increase about 5 to 7% this year. And we'll talk a little bit about why that is. This has really been an emerging asset class. You're probably hearing more and more about MLPs over the last few years, not only because they've done so much better, but there's just so many more companies that are considered MLPs out there today. Today, there are about 100 companies or so that are considered MLP-related companies with a market cap of a little over $300 billion. just a decade ago, 10 years ago, there were about a dozen companies valued at about $30 billion in total. So you can just see the growth just over the last 10 years that we've had. We think that we're still early in the game, which is why there's, I think, still sort of a value proposition on the table. There's been some studies done that the U.S. will need over $250 billion in energy infrastructure built to handle just the existing new sources of gas and crude oil. And that's mainly as a result of a lot of the new technologies, whether we like it or not, and that can be argued. There's so many new technologies where we're extracting, gas and oil out of shale and other areas. And a lot of this just came on board over the last couple years. And we'll kind of take a look at the map and show you in a little bit of where those places are. But the bottom line is that with natural gas being so inexpensive now, it's a lot more expensive overseas. There's a lot of talk about exporting natural gas, and with all these new deposits in shale in different parts of the country, we need to get that somewhere. And again, MLPs are the conduit to transport that oil and gas. And at this point, there's really a few choices to generate income. And again, today with a lot of our retirees, the conversation is always about income. I mean, literally every day we talk about this as an investment committee, ways to generate income. And this is certainly one of the areas that we're coming to more and more as we look forward. And if you can look at here, the yield, the average yield on MLPs was about 6.5 at the end of last year. You compare that to 10-year treasuries at 2%, utilities at 4, REITs in the mid-3s, and lower rated bonds about 4.5%. It's not a bad place to be. So again, one of the reasons why we think performance could be positive is investors like you that are sitting here and saying, wow, 6.4%, that's not bad. Hey, I'm retired. That could be a good source of income for me. So again, with sort of MLPs being more and more known, and we're seeing more media come out about MLPs, I think firms like ours, you're starting to see more and more firms like ours use them when it comes to diversification. And as sort of the word gets out more and more about some of the attributes, I think we'll see a continued positive momentum in that industry. This is just a quick chart for those of you who might not really know where a lot of these shale plays are. This is looking at new and emerging shale plays really throughout the country. So, I talked a little bit about this earlier on the upper right here. We had the Marcellus Shale, Balkan. There's areas of Texas that, forever we've been getting natural gas and oil out of. But these things are really popping up all over the place, and there's more and more that we're finding. And as I said, with the new technology available, it's just been a really exciting time to be, in this space. So again, I wanted to make this short. We'll answer some questions afterwards, and for anybody who's interested further, whether you're a client now or somebody who's just listening to this, we'd be happy to schedule a little bit more time to talk about some of these different things, specifically the instruments that we use to access these type of investments. One of the things that I will say is that as structured as a partnership, if you do buy these companies outright, it can get a little hairy with K1s as far as being, lots of K1s coming, which tend to be cumbersome and, can cost a lot more money when it comes to filing the tax returns, et cetera. And there are ways to access these things through certain mutual funds and ETFs where you would get a regular 1099 and just, making the tax situation, a lot easier. But really, in sum, as far as how they add value to portfolios, we see a current yield at this point between 6 and 7%. We do think that, depending on the price of MLPs, that distribution at least will increase over time. It's been over a 20% annual return, which, being in your shoes and being in our shoes, it does make you a little nervous that this is an asset class that's performed so well over so long. And the question is always, well, what does that mean going forward? And while, generally I would look at anything and say, wow, that just can't continue. While I don't think it's going to be 20%, we do think expectations in the, high single digits when we look at the income, that's generated and the appreciation of the index itself. We could see, high single, low teen digits at least over the next year. And this is, certainly delivered last year about a 10 to 11% return. Low correlation, we talked about that to the stock market, inflation protection, and there is some tax efficiency of MLPs. The distribution historically have been treated as some of the distributions have been a return of capital, so that certainly helped from a tax perspective. But who knows what's going to happen next year with tax changes, et cetera, going forward. So with that in mind, again, if you have a question, you can feel free to type it into the computer, and I'll probably see that if this is all working correctly. Or you can raise your hand on the computer, and I'll unmute you, and you can go ahead and ask the question. So, again, I appreciate your time today. We did want to keep it short, and we'll go from here. So, if anybody has any questions, please just raise your hand or type one in, and we'll get to it. This happened last time, and apparently people did have questions, and our technology didn't recognize it. But I think not seeing any questions come up at this point. Oh, we do have a question. So, Andres, why don't you go ahead and ask a question? Appreciate it. Okay, the question is, okay, this is a good question. The question is, can you talk about the different instruments using, hedge fund MLPs versus, say, ETFs? Also, can you comment on Swank Capital, one of the bigger names? So, we think it's important. Again, a lot of our, we have separate account managers that manage MLP portfolios for generally larger minimums. These minimums are $500,000 or more. And, the issue is, and for some clients this doesn't matter as much, but for some clients it does. When you own the MLP outright and you own a portfolio of 25 to 30 MLPs or more, you have 25 to 30 K1s that are coming to you, and again, it can increase the costs of the tax return, the complexity. It can delay the tax return, et cetera. So anyway, depending on the size of the allocation, we don't like to go too crazy here with MLPs because you just never know. There are some risks out there. These companies tend to be leveraged, so when interest rates go up, they're potentially there's somewhat of a headwind there. God forbid, if there was some kind of explosion, there's not as much of an issue as, say, an offshore driller. We know that from a couple of years ago when something explodes or goes bad, that can be a total mess, literally. Versus when something happens, a leak, et cetera, happens here through a pipeline. And I don't mean to belittle, the disaster and the problem, but generally liability can be, contained, and it's not as bad as something else might be. So we, depending on the amount of capital that somebody's investing, we sort of like somewhere between 5 and 10%, and we can go higher as far as an allocation of the portfolio to MLPs. So again, to access a lot of these sophisticated managers outright, you're talking $500,000 to $1 million minimum. While some people can swing that, a lot of the people can't, especially if this is only a 10% allocation in the portfolio. So we do like going through different ETFs and different mutual funds because you're getting you're getting a 1099 at the end of the year as opposed to some of the other again complex K1s. The Alerian, A-L-E-R-I-A-N, I believe. They have a couple of really interesting indexes. One, if you look on their website, you'll see two of them. One tries to track the MLP index by investing in derivatives, so using options to recreate the index. And the other one is investing in some of the companies outright. So, I think they're both really interesting, to look at, and we use both of those in our portfolios. Again, for clients where we can, have the $500,000 to $1 million minimum to just access these, we have separate account managers that can go ahead and build those. So, as far as the question about using the hedge fund, we haven't really used hedge funds in my opinion for this space anyway. We use them for other spaces, but I think anytime if you can get a good index, a good kind of lower cost index fund where you don't have the lockups of a hedge fund and the liquidity issues that a hedge fund tends to have, it's generally a better way to go, unless the hedge fund just has such a stellar performance that it's it's worth having that illiquidity and lockup. But we just haven't seen really any good hedge funds in this space, in this MLP space. But we're always looking. And I'm sorry, Swank Capital. One of our analysts here, I know they know them pretty well. I don't know them as well. I know that we've recently been looking at them. So again, I can't comment, but my email address is tvernon@biltmorecap.com. If you want to shoot me an email, be happy to kind of follow up with you on that with our analyst on the phone. Anyway, any other questions? MLPs, alternatives in general. Again, feel free to just send it over the computer or raise the hand and talk a little bit more freely. Okay, I don't think we have any other questions, so I appreciate your time today. As I said, I did want to keep it short. Sometimes keeping it short is good. Sometimes people want to go longer, but again, if you would like to talk a little bit more, we'd be happy to set up a call and even bring on one of our MLP managers on the phone to talk a little bit in more detail. Thanks again. Have a great day and a great weekend. Bye-bye.